इसके बेसिस पे assumption के बेसिस पे लॉ सकता है एक्विजिशन cost of production is constant. So लॉ सकता है assume that the price of a product varies even though there is no change in cost of production. The cost of production increases but the increase in price of product then it is not beneficial for the sellers to produce more than supply. Technique of production is unchanged. Log supply assumes that there is no change in technique of production. It is necessary for the cost to remain constant. With improvement in technique reduces the cost of production when the seller is supplying more than the price. Fixed scale of production. During specified period of time, the scale of production is constant. If the scale of production changes, then the level of supply automatically changes. Government policies are constant. So it is assumed that government policies such as taxation policy, trade policy. So yesterday we discussed about the risk adjusted discount rate. So in that context, we have something here. So this risk adjusted discount rate is nothing but the WACC, weighted average cost of capital, plus or minus risk adjustment. So I think you have some idea about WACC, Zarina? Yes? Hello?
Yes, yes, yes.
Yeah. So
Hello,
we have
yes.
already done the WACC calculation. So simple. Suppose your WACC is suppose 10%, and if at all the company in which you want to invest, that company's risk has increased to some the risk has gone on a higher side, or we can say the company is on verge of bankruptcy, or some kind of risk has kind of increased in that company. So you can add you can definitely add like 2% for that. Why? Because since the risk has increased, you definitely demand a higher return, so that you get compensated for that higher risk what you're taking of investing in that company, correct? And if the risk is reducing, you can reduce it minus 2%. Got my point? That
Yes,
is called
risk adjusted discount
risk
rate.
adjustment. Okay. Okay. Yeah. So Zarina, you can go for this question. Three examples and explain me what they are saying. Okay, I'm waiting.
Okay, sir.
Yeah. Yes, Zarina, can you elaborate on that?
Yes, sir. In the first example, it's saying that a company's thinking to invest in involving new market in a new project, and where they have much risk and failure is high. So
So
the due
companies
diligence,
considering new project that involves entering a new market where competition is
yes,
stiff and the risk of failure is high, of course. That is what the data is given. Because of these factors, the project will add significant businesses to the company's operating
yes, and
environment,
might
and
be,
as a
yeah,
result, investors will require higher rate of return to compensate them for the additional risk what they're taking to invest in this company, correct?
yes,
So some
exactly,
firms WSCC has to be adjusted, correct, with higher return.
yes, sir.
Can you just tell me about the second one?
A second one, companies
In fact,
deciding
everything is going
work,
in the same
yeah,
manner. Like risk is increasing, you
yes,
have to
risk is
add
increasing. Either they have
premium.
to
If not, then less.
higher discount rate in the capital budgeting analysis,
Yeah.
or else they have to increase the return to
Yes. To
satisfy the
compensate
investors.
for a higher risk what they're taking. Fine. All the three
Yes,
questions mean the same. So this yesterday we have finished. CAPM. We have done a question on the. Achha, did you do this homework? No.
this
Hello.
example, sir. Hello, yes, sir.
Yeah. Have you done
Yes,
this question?
yes, I did.
Good, good, great. So we'll do real options in capital budgeting. We will finish this and then go backside and do that pending topic. Okay.
Okay, sir.
Yeah, almost all this is a 10 minutes lecture, not more than this.
Okay.
Real options in capital budgeting. So to analyze a proposed capital budgeting project using NPV, it's necessary to make estimates of expected future cash flows and an appropriate discount rate. Of course, whenever you invest, there's an outflow. Then you expect inflow, and those have to be discounted with the appropriate discount rate. So at the most basic level, management can calculate a single NPV, decide to embark upon a project, and then wait until the project's term runs its course. A decidedly passive approach. Okay, so what is happening? Basically, what management can do, they can calculate a NPV, then they can see whether to go into the project or not, and then can enter into it and then see what is happening. However, a project's NPV can be calculated only with information known at the time the estimates are made. Yes, because you are doing it beforehand, not after starting the project. So, and the choice is between accepting or rejecting the project. Thus, NPV approach ignores the fact that other choices may be made and that option to make other choices can have value. So, like there is to be some other factors to be considered which has not been considered in NPV approach, which have to be considered, which are important for the project, which we have skipped till now. Now we are going to study and discuss about that. The real options approach addresses the problem of optimizing a real asset, such as piece of equipment, building, land, or project, so forth, under conditions of uncertainty given the available options. So real option, see, what we estimate is all, we estimate like all else good. That means everything is all right, and we are going to operate in that good environment where we are not going to face any kind of hurdles or obstacles. But can you do you think obstacles and hurdles are not going to come in the project, in between the project? It is going to come. It is because this is the part and parcel of life, correct?
Business or
So
real
real
life. Yes, sir.
options goes beyond the basic passive approach to NPV and project management. Instead, real options give a framework for strategic decision making as the project goes along. In essence, real options begin with an initial choice that is then followed by additional choices that factor in as more information becomes available. So those are also important factors to be considered, other things even. Okay, so Waynes Upton Jr. provides a comprehensive discussion of real options. Real option is easier to describe than to define. Yeah, we cannot define them, but yeah, we can describe what can happen. So a financial option is a contract that grants to the, see, first of all, let me tell you what is an option. Option is such a contract which gives you a right, but you're not obligated to fulfill your part in that option contract, correct? So I'll write it here. Option.
Yes, sir.
Option, it's a contract which gives you a right. but it's not an obligation. But it is not an obligation. Now this is a statement which is something which you have not come across. See, very simple example I can give you. For option, there are 3 schools and you want to enroll your sibling into one of the schools, and this is 10 kilometers far away from your home. This is just 500 meters walkable distance. This is 5 kilometers. The fees for this school is 2.5 lakhs. For this it is 1 lakh. For this it is 30,000. You have to select the 3, select one out of the 3. Okay, mutually exclusive. That means you cannot take all the admissions, correct? Because your sibling is going to get enrolled into one of the schools. So for that,
Yes,
what you have done is you have just taken the admission form of this and this and filled up, and you have submitted the forms. Here you have spent 1,000 rupees for the form, 750, 300. Now the form which you have filled up for the admission is option to take an admission, not the admission itself. Got it?
yes, sir.
You have not paid a fee amount to the school. You did not pay part payment or like 3/4 of the payment. You did not make any fee payment to them. You just took the option to take admission in the schools. Okay. Now
Yes.
what happens if you would have paid some amount to these guys as a part of admission, like some 25% or 50%, then they would have demanded money from you in the future, and their obligation has got created. If you did not, if you deny from paying that, they would drag you to the court of law and they can claim their amount. Why? Because you have made a contract with them as per which you are obligated to make the payment to them. But in case of
Yes.
admission form, you're not obligated. Why? Because you can cancel the admission any point of time, and the minimum amount you lose is this and this if you finalize this, correct?
Yes, sir.
That is option. So this option we can replicate. We can take this option into the various other while doing some other concepts. I will get back to that. It is not there in details to you right now. Here just we are discussing about the option. Okay. So to simplify the things, I have given you this example. So options have to be taken. That means options should be considered. What kind of in future we could get some kind of offer, or we could we want to exercise some we want to take a judgment in the future. In that case, we should have some options with us. Correct or wrong? Yes.
Yes, sir. Yes, sir.
That is what you need to consider in capital budgeting projects. So now here, let us say, for example, a company might consider a project that, while attractive, has a negative NPV. So that's a good project, but it is giving you negative NPV. Under most conditions, company should avoid the project. However, it is possible that, based on real option analysis, a company might be more willing to undertake such a project because it would offer expansion opportunities, or because it could be abandoned if conditions turn unfavorable. That's what. So they are keeping an option with them. What is the option? Either they can expand or they can close it if things did not go in their favor. Correct? Isn't it so?
Yes, sir.
See, option would
Yes, sir.
only be exercised if at all that benefits you, or if that goes in your favor, or else you will never exercise an option. So in these 3
Yes.
schools, you have opted this because it was best suiting you. These were not suitable, or this you were not you considered these are not feasible for you. Correct?
Yes, sir.
So these types of options, the flexibility to stop, restart, so flexibility. So here option gives you a great amount of flexibility. So you are flexible enough to either stop or restart or reconsider, and can have specific values assigned to them. So it is possible that negative NPV project would be undertaken because of the value of its option. That means maybe in the future you may have a different goal, even though the project would not be profitable, but you want a share in that market for some point of time, or you're looking for expansion. So you want to take a SIC unit. Anything is possible. So you keep options open, correct? So what are the options here? We need to consider one option to make follow-on investments if immediate investment project succeeds. So that means if you have done an investment and that investment has proved to be fruitful or profitable for you, so you consider to invest more money in that in the future. That option you keep alive. That means that option you're keeping with yourself. Option to abandon a project. You don't want to continue. You want to just leave it. Option to wait and learn more before investing. That is also what you want to consider. Option to vary the inputs to the production. So yeah, if the demand, if it is the need of the hour or the demand is such, you need to like change, make some changes to your estimates. So you can have that, you can keep that option based upon which you can change the inputs to the production process. Growth options, flexibility options. Okay, so growth options, as an example of growth option, is the decision to invest in entry into a new market. Yeah, and flexibility option, an example of flexibility option is the choice between building a single centrally located facility or two facilities in different locations. It depends like how flexible you are and what flexibility it can give you related to your work. Okay, then bailout, payback, and real options. So the bailout payback is a variation on the payback period method of capital budgeting. We have already done this, and it is one method of quantifying a real option. How? See, quantifying is nothing but options, whatever you have. If you can put like measure something in terms of some numbers or numericals, it is called quantifying. Okay, so the bailout payback period is calculated in same way as the payback period, but it recognizes that the project may end prematurely and the assets may be sold. That means you could be able to recover whatever you can like before the maturity what you have estimated or considered for the project, and then when you recover you can sell the assets, correct?
Yes, sir.
So the recognize that a project may end prematurely before the timeline what you have fixed, and the assets may be sold. So the after tax salvage value of project assets at various dates is added to the project's cash inflows through the same dates. This process essentially includes in the payback period a calculation of cash flows that result upon the termination of the project at various dates. So the bailout payback method of analyzing a capital budgeting project is one method of quantifying the abandonment option and offers a form of protection if things could go wrong. That means you want to sell it premature because you think things are not going to go in your favor, or you are going to incur some losses, or you will not break even, or you will not be able to recover your cash. So you want to close the project beforehand, like beforehand in the sense whatever you have estimated before that, and sell the assets and recover your money back. Okay, that is called bailout payback period. I think decision tree is not there for you, but we have already learned about the decision tree. Valuing the real option, see, the valuation part is not given to you. Okay, so we will not go into this. But what they have said is the project's NPV with real option is its value without the real option plus the value of the real option. So what is the project's NPV? NPV with real option plus the real option value gives you project's total worth, correct?
Yes, sir.
Hello?
Hello.
Yeah, did you understand
Yes,
what I said?
yes, I got it.
Yeah, so if you want to find out the real option value, project's worth minus NPV without real option, correct?
Yes.
Monte Carlo simulation done, other methods of valuing real options. I don't want you to go into this. They won't ask you in the exam. It is not there in your syllabus also. Okay, we'll go back and do the other topic. Okay, now this is the last topic which we are going to do. Present value break-even analysis. So what does it do is this is the method which combines break-even analysis with NPV to determine the number of units a firm must sell incrementally as a result of capital project to achieve NPV of 0. In other words, break-even NPV. So here what they are saying is how many units you need to sell. As yesterday I have explained you, break-even units is nothing but number of units you should sell to break even in your project. So here what we are doing is we are clubbing break-even concept with NPV. So here we are saying that how many units you need to sell to get the NPV of the project exactly equal to 0, or you need to break even, correct? Or break even NPV. Got it?
Yes. Yes,
Suppose
sir.
if I sell 1000 units and if I get NPV exactly as 0, that means it is like a break even, because the present value of inflow is equal to present value of outflow. Correct?
Yes, sir.
So you must have, like, you would again remember about the IRR. IRR was nothing but the discount factor at which your
And
NPV is
equal
0.
to 0.
But here
Yes.
we are seeing number of units, not discount factor. Got it?
Yes, sir.
So how to go about it? First, we have to find out the equivalent annual cost. So these are the methods you need to, these are the steps you need to follow to find out the present value break even. So first and foremost point, calculation of EAC, equivalent annual cost. So initial investment by present value of ordinary annuity factor. Why are we doing this? Suppose my initial investment is 1 lakh. Okay. And my present value of ordinary annuity factor is, suppose, let's say 4. So what is my equal annual cost?
25,000.
25,000. That means I am incurring 25,000 every year, correct? And you know
Yes.
about annuity when you have single set of cash flows, correct?
Yes.
So 25,000 is my single set of cash flows every year. That means 25,000 is the constant cash outflow every year from my out of my project. Now,
Yes, sir.
second, what we'll do, we'll find out the present value break even. How will we do that? We'll take the equivalent annual cost, plus we'll add the fixed cost that is like adjusted to tax, minus the depreciation into the tax rate. Okay. So what we are doing, we previously used to take fixed cost with depreciation. Now we are taking fixed cost without depreciation, correct?
Annual. Yes. Yes, sir.
So EAC is equivalent annual cost plus in bracket fixed cost minus depreciation we are removing by
Yes.
sales minus variable cost into the tax adjustment. Okay. So we are taking the fixed cost not including depreciation. Got it?
Yes, I got.
Why are we doing this? But
To find the break even.
yeah, no, the major reason to do this is, so here this is also fixed now. Here 25,000 is fixed every year, isn't it so?
Yes, sir.
And this is fixed. Only we are removing this. The reason they have given is, see, fixed cost is annual cash fixed costs not including depreciation multiplied by 1 minus tax to express it on after tax basis. Annual depreciation into T is nothing but your depreciation tax shield, isn't it so?
Yes, sir.
You remember we would claim,
Yes, sir.
yeah. So it is subtracted from EAC and annual after tax cash flow outflows for fixed cost, because the depreciation tax shield results in lower taxes for the company, thus decreasing annual cash outflow. So that is what we are removing this, because what would happen, you are only considering the outflow and depreciation tax shield is kind of an inflow which could reduce your outflow, correct or not?
Yes, sir.
Isn't it so?
Yes, sir. Yes, sir.
So like what we are doing is, from this, if it is subtracted from the EAC and annual after tax outflows for fixed cost, because depreciation tax shield results in lower taxes for company, thus decreasing annual cash outflow equivalent to increasing net annual cash inflows. Yeah, if this is reduced, that is increased, of course. So we just don't want this thing here, because we want all the costs to be added in the numerator, and this would result in cash inflow rather than outflow. So we only want outflows in the numerator. Got it?
Yes, sir.
We only want the outflows in the numerator. Then you get the number of units you need to sell for your break even or your zero NPV. Correct?
Yes, sir.
So can you just do this question?
Yes,
Yeah.
I'll try.
Yeah, please do this. Zarina, finished? Hello? Hello?
Hello. Yes, sir. Yes, sir.
Yeah,
Just
finished?
final
Yeah.
calculation. Yes.
So the present value break-even point in incremental volume is this. Additional crusts must be sold since a partial crust cannot be sold, it seems. So now the proof, we have to see the proof now. So what is the
Yes.
proof? So we have to see whether we are getting NPV as 0 or not. Isn't it so?
Yes, sir.
You have just found out the present value
Yeah.
break even, number of
Total.
units to be
Yes.
sold. Yeah. Suppose if I'm taking those many units and I'm seeing the contribution, that is sales minus variable cost, I get the inflow. Then I remove the fixed cost, I get the net operating cash inflow before tax. Remove the taxes, I get the after tax inflow. Then
Depreciation.
tax shield I add back, I get this amount. And this is my every year's inflow, it seems. Okay, so present value of annuity at the rate of 10% for 5 years, if I do, I get this. That is almost equal to 1 lakh, correct?
Yes, sir.
So if I just do the difference, I get $2. That is negligible. So I get a 0 NPV, isn't it so?
Yes, sir.
So that has proved that this is my break point. I shall sell
Yes.
this much units to get my NPV 0.
Yes. Sir.
Yeah, you can just go to this, Zarina. I think we are done with the chapter. Let's start a new chapter tomorrow. And I'm sending the PDFs right now. Okay.
Yes, sir. Yes. Sure.
We got fed up with this big topic. This week things would be very fast track because I'm going to finish 4 chapters in a span of 7 days.
Okay, sir. Sure.
Yeah. Once done with this, you can inform me.
Yes, sir.
Okay, sir.
Done, sir.
Yeah. Okay, Zarina. Then we will take the next class tomorrow and we'll start with the first chapter, financial statements. Okay.
Okay, sir. Okay.
We are done with a very big topic in part 2. Ratios done, investment decisions done, ethics done in
Thank
this 3.
Yes.
Yeah. Now we'll focus on part 1 from tomorrow.
Okay, sir.
Okay, Zarina. Thank you.
Thank you.
Thank you. Bye.